Cash flow in a rising rate environment sounds like a punchline, doesn't it? Like asking which swimsuit works best in a blizzard. But stick with us, because the investors quietly printing money right now aren't the ones you'd expect. When the Fed started hiking rates back in 2022, the consensus was simple. Real estate is toast. 30-year fixed mortgages punched past 7%, cap rates got squeezed like a lemon at a juice bar, and suddenly that passive income dream started looking a lot more like a passive headache. Here's the thing though, rising rates don't kill real estate investing. They just kill lazy real estate investing. The strategies that survived and thrived share one common thread. They stopped fighting the rate environment and started working with it. Let's talk about the big winner first, and that's short-term rentals done with surgical precision. When your nightly rate on a well-placed Airbnb can cover what a long-term tenant pays in a month, the math gets very interesting very fast. But we're not just talking beach houses and mountain cabins. We're talking medium-term furnished rentals targeting traveling nurses, corporate relocators, and remote workers with expense accounts. These tenants pay a premium, treat the place like a hotel, and leave before they ever become a problem. Now here's the irony that nobody talks about at dinner parties. High interest rates actually create one of the best buyer's markets for certain investors. Sellers who bought in 2020 and 2021 at low rates are fine. But the ones who bought at peak prices in 2022 with adjustable rate mortgages, they're motivated, friend. That's where the DSCR loan debt service coverage ratio becomes your new best friend in this climate. Unlike traditional financing, lenders qualify you based on the property's income, not your W-2, which means the asset carries itself on paper and you stay in the game. House hacking is having a full renaissance right now. And if you're sleeping on it, you're paying rent for no reason. Buy a small multifamily, live in one unit, rent the others, and watch your tenants subsidize or completely eliminate your mortgage payment. History keeps showing us this same movie with different actors. Every rate spike feels catastrophic, and every rate spike eventually ends. The investors who bought in 1981, when rates hit 20% and held through the drop, didn't just survive, they built generational wealth. The biggest misconception is that you need cheap debt to make real estate work, and that's simply not true. You need the right deal, structure, seller financing, assumable mortgages, lease options, tools that let you sidestep the bank entirely and create terms that actually cash flow today. Here's your practical playbook, and write this down. Underwrite conservatively at current rates. Never count on appreciation. Always stress test your numbers at 2 points higher than today's rate, and only buy what makes sense on day one. Discipline in underwriting is worth more than any market prediction you'll ever read. Position size matters more than conviction. Don't bet everything on one deal because you know it's a winner. And don't sit paralyzed waiting for rates to drop to 3% again like we're all going back to 2020. Smaller, smarter bets, placed consistently, beat one moonshot, swung with emotion every single time. At the end of the day, the market doesn't owe you perfect conditions, it owes you nothing. And the investors who accept that truth first are the ones who adapt fastest. Strategy, patience, and honest numbers are the only durable edges in any rate environment. Whether rates go higher, stay flat, or finally begin to fall, the prepared investor is genuinely comfortable with any outcome because they've already built in the margin. That's not optimism, that's engineering. And if you're ready to stop theorizing and start building, whether that's real estate investing, finding a contractor for your next project, or connecting with the right lender, check out our links in the description below and let us help you take that first step.